So if the market maker got an average about where this shaded area is, and you see that the down candles gave them an average of roughly down here, you see the market maker made a fortune on that phase. A fortune on that phase. But here's where you see that you can't just trade this as a thing. Look, massive volume arrival. It's quite obvious what's going on here, right? So if you just thought massive volume arrival, I'm just going to jump in and sell it, well, you just got murdered. If you sold it there, you did okay. So you've got to remember that you can't just take these as trades. What you've got to try and do is read it. The best way to sell volume is actually to wait until it gets trapped, right? So if you saw a big candle like this, you could always put in a sell right like here. If you saw a big candle like this, you could always put in a sell maybe about here, right? So you're trading it if it does reject. So when you saw this big sell candle here, you could say, well, I'm going to take a buy if it goes back above that area there, for example. It's not about a candle reversal. It's about just seeing that the majority of the volume is now in the right side for you to make some money from. Take it back to volume. Because these high value areas, these high volume areas are different things. High volume candles are usually not high value area profiles. They're actually usually quite low value area profiles because they generally mark turning points, which makes them low volume areas. If you look in the background, of course, if we highlighted the low volume areas, they all come from high volume candles. There, for example, right? And then there, for example, right? And then there, for example, right? They all come from high volume areas. High volume candles, rather. So high volume areas come from low volume candles. High volume candles create low volume areas, rejection areas, areas of imbalance that can be adjusted and reversed by the market maker, areas of danger for the market maker where too many money didn't trade. So we're going to finish off at that today, guys. I know we said we'd do this classroom a wee bit shorter than the Wednesday and Friday class, but I hope again there was something of interest. And if not, guess what, guys? We're going to have to try all over again. So we did the market maker game today. We talked about the arrival of volume as a very important feature. And then, of course, in tomorrow's classroom, we will start looking at other arrival rates. We'll be looking at the Voltics again. We'll be looking at limit order book liquidity. Why is it spoofing? What is spoofing? What is order stuffing? What is washing from a market maker's point of view? So we've got these elements to add to it from a liquidity point of view. But more importantly, we need to be very aware and switched on to a big arrival of volumes. If you do nothing else in your trading career, the arrival of volume is something you must attempt to understand if you're going to be successful. Have a good one. I'll see you guys in the morning. I'm going to say adios amigos, arrivederci. Auf Wiedersehen, sayonara, tot ziens. Tak ska do svidania, and spasiba. Meantime.